UK GDP contracted by 0.2% in the second quarter of 2019, down from the relatively strong 0.5% quarterly expansion that we saw in Q1 2019. The economy shrank for the first time in almost 7 years, underperforming the Eurozone, the US, and Japan. Despite some good underlying fundamentals such as strong wage growth and a low unemployment rate, Brexit headwinds and slowing global growth caused the economy to underperform city economists' forecasts of zero growth in Q2. Although generally considered unlikely, a further contraction in Q3 would mean the UK entering a technical recession. Manufacturing fell back after a strong start to the year, contracted by -2.3% in the second quarter. Construction also performed badly, with output contracting by 1.3% in the quarter, reflecting a 6% drop in repair and maintenance work. Services was the only sector that made a positive contribution to overall GDP growth in Q2, growing by 0.1%. The Ernst & Young Item Club maintained its GDP growth projections at 1.3% for the year and 1.5% for 2020. However, these projections are based on the assumption that the UK leaves the EU with a deal. The club noted that there were 3 distinct Brexit possibilities, each of which were likely to lead to a very different economic outcome. Against the backdrop of weaker global growth, Brexit uncertainty continues to linger. The growing risk of falling off a Brexit cliff edge and weaker than expected GDP data hit sterling in the second quarter, sending it to a 2.5-year low against the dollar and euro. As expected, stockpiling activity slowed in the second quarter after the rush to stockpile products in the run-up to the original Brexit deadline in March 2019. The economy is expected to expand again during the third quarter as companies once again rush to stockpile in an attempt to cushion the blow of a potential no-deal departure. Material risks to the economy remain, and crashing out of the EU without a deal will certainly have a negative impact on the economy. However, according to Bank of England Governor Mark Carney, the impact of a no-deal Brexit would be less severe than first thought, saying that recent preparations for a disorderly departure had helped to reduce the likely hit to the UK economy.
The UK Construction Purchasing Managers Index came in at 45.3 in July 2019, a modest rebound from the previous month, but still the second lowest reading since April 2009. This is also the 5th time in 6 months that construction activity has contracted. Across the UK as a whole, July's PMI survey revealed that commercial construction was the worst performer, closely followed by civil engineering activity. The contraction in the usually strong house building sector softened from June's 3-year low, but challenging market conditions remain, with less work to go round. The survey respondents also noted that new orders dropped for a 4th consecutive month, leading to cuts in employment numbers and a sharp fall in purchasing activity. Focusing specifically in London, construction output fell once again in the first quarter of 2019, with the all-work figure falling -2% from the previous quarter to 8.29 billion. The only subsectors that experienced any quarter-on-quarter growth was infrastructure, where new work grew by 57.5% and repair and maintenance by 24.8%. London residential new orders increased in Q1 2019, rising by 57% from the previous quarter to 1.35 billion. The spike meant that new orders rose above the 5-year quarterly average of 1.01 billion. Despite reports of muted activity in the London office market, London commercial new orders in Q1 2019 actually rose by 8% from the previous quarter to 1.74 billion, the highest quarterly value since Q1 2017. With sterling continuing to track lower, there has been a rise in interest from international investors from countries such as the US and China propping up demand. New orders in London for all new work doubled in Q1 2019. This jump was largely due to strong growth in London infrastructure, a sector that saw new orders explode from 24 million in Q4 2018 to 1.96 billion in Q1 2019. The spike comes shortly after the UK government set out plans to invest £600 billion in infrastructure development over the next decade, 190 billion of which would take place by 2020 and 2021. The UK Construction Material Price Index for all work was up by 3% in June 2019 compared to the same month in the previous year. After being overinflated from Brexit-related stockpiling in Q1, the rate of material price inflation subsided in the second quarter of this year, providing some respite to companies hurt by recent material price increases. The price of most of the key construction materials in our graph actually fell between the end of Q1 and Q2 2019. Only fabricated structural steel and precast concrete products experienced modest cost inflation, rising by 0.5% and 0.9% respectively. Imported sawn or plain wood saw the largest price reduction in the second quarter, falling by -2.4%. Cost inflation for the material was substantial last year, with prices rising 11.8% in 2018, but prices have since retreated to mid-2018 levels. Cost inflation of fabricated structural steel softened in the second quarter of 2019. Slowing global demand coinciding with an increase in global supply due to record steel production in China and the resolution of supply disruptions in Brazil has put downward pressure on iron ore prices.
A weaker pound also had a part to play. The pound fell 3.5% against the euro and 2.5% against the dollar in Q2 alone, and continued its fall into early August. Between the end of March and mid-August, the pound fell around 7% against both the euro and the dollar, adding significant upward cost pressure in all imported construction products and materials, which account for just under 25% of all construction products and materials used in UK construction. In terms of trade packages, we anticipate both M&E and facades to experience the greatest package inflation rates over the next 12 months. This is largely a result of high demand for skilled labour in the case of M&E and increased workloads creating supply pressure in the case of facades. Finally, G&T continues to forecast 2019 and 2020 tender price inflation for London at 1%, rising to 1.5% in 2021 and 2022. The increasingly competitive market conditions mean that higher input prices are not fully feeding through into tender returns. Contractors remain under pressure to secure pipeline work, absorb input cost rises and accept constrained margins, while some much-needed clarity is provided regarding the political landscape. If you would like to learn more about G&T's quarterly London market update or see our most recent tender price inflationary forecasts, please visit our GT Market Intelligence website.